Financial markets have been whipsawed recently by central bank speak. On the 13th of December last year, the chair of the US rate setting committee electrified the markets with talk of early US rate cuts. A strong rally in bonds and equities followed, not just in the US, but across the world. Expectations of hefty and early rate cuts were then priced into markets in New York, in London, Europe and beyond. This year has seen a significant reversal. One after the other, central bankers in those three centres have consistently pushed back on optimistic market expectations for rate cuts. So where are we left? Although the themes of falling inflation and low unemployment are common across the US, UK and Europe, important differences remain when it comes to the timing of rate cuts. In the US, near-term measures of consumer price inflation are at or close to the 2% target, and slowing wage inflation suggests that this move can be sustained. Politics is also playing a role. With the most divisive presidential election in modern times in prospect, the Fed do not want their decisions on interest rates to be an issue. Were they to make the first cut in March, well, that would help enormously in that respect. But it needs to be justified. The Employment Cost Index, which is due out at the end of this month, well, that will be important. It's generally regarded as the best measure of wage inflation. It only comes out quarterly, and if it moves below 1% on a quarter-on-quarter basis, it could well tip the balance towards a rate cut in March. That's certainly my expectation. Now, with unemployment low in the US and the economy growing steadily, there's no urgency to cut rates from this side. But monetary policy is restrictive, and a modest cut in the spring would help to depoliticize subsequent decisions. The first rate cut will get a lot of attention. Ultimately, we expect steady rate cuts in the US towards the market's expectation of 4% by year end and beyond. Over in Europe, inflation also fell steeply, very steeply towards the end of last year, well below the European Central Bank's forecasts. But the outlook for wage inflation is more cloudy. The wage round in Europe has just kicked off, and although there are good reasons to expect a big slowdown, the ECB will want to wait to see the results themselves. A rate cut in April, well, that's a distinct possibility, but they may wait until the meeting in June. The outlook for wage inflation here in the UK is equally murky. Yes, near-term measures for wage inflation show a big slowdown, but that slowdown's coming from a very high level. Moreover, the 10% hike in the minimum wage in April, that could put further upward pressure on wages. Now, the low pay unit who come up with the figures, they did a good job of convincing many that the increase would have only a limited effect, arguing that wages, notably in retailing, had already risen above the new minimum. Well, Sainsbury's 9.1% wage award announced just a few days ago, that suggests otherwise. The prospect of big tax cuts in the March budget, we expect 2p off the basic rate of income tax and a rise in thresholds, that will also encourage caution. Despite all this, we expect the Bank of England to follow the Fed and the ECB with big rate cuts this year, but we think they'll probably be the last to make the first move. What about the rise in shipping costs as a result of all the problems in the Red Sea? Won't that cause a resurgence in inflation and stop rate cuts? Well, yes, shipping costs have jumped, but the scale, as you can see from the chart, is much less than in the aftermath of lockdown. And there's another important difference. Back then, businesses were scrambling to rebuild inventory, and strong demand made it easy to pass on higher prices. It's a different story today. So yes, I do expect an impact, but I think it could be modest, and let's hope it's temporary. We shall see.